Hi guys, in this video we're going over chapter 15 which is corporate taxation. Now this book is really from the perspective of an individual, which makes sense, right? Because this is a community college level tax. As you may have noticed, there's a lot more to taxes. I know a lot of times people think, I'll take a class and I'll know everything. But probably the biggest thing you learn is what you don't know, right? Because you could not understand how much there is to know unless you start learning it. So we're really going to focus on the perspective that the book takes as an individual. And that's why I'm going to just go through the book directly and go over some of their examples and such. So, and I'm going to give you a little bit of a different intro starting by looking at the form. One of the main concepts here to understand is that this chapter includes the C Corp and the S Corp, which is kind of interesting because the S Corporation I would prefer to cover with the partnerships. I think it more resembles a partnership than a C Corp. The point of the S Corporation was to combine the benefits of the C Corp with a partnership for smaller businesses. And so that's where the S Corp came from. They kind of throw the S Corp in here at the end of the chapter, and which is an interesting approach because the S Corp, I don't want you to think that these things are small because that's the way they're presented in the book. It's just that we're only kind of looking at it from a surface level so you get familiar with it. C Corp taxes are far more complicated than individual taxes, right? But we cover the self-employment a lot because it's so common for individuals. It's rather uncommon for individuals to encounter C Corp taxes. Even if you're working at a local tax firm, it's fairly uncommon to encounter C Corp taxes. Now, you want to understand the C Corp because it does, because the S Corp is extremely common. And people have a big misconception that the S Corp saves them a bunch of taxes, and so they try to form it very quickly. So there's many people in the S Corp situation. Anyways, it's enough for now. So we're going to talk about the corporate formation and filing requirements, which I kind of covered in that first video. We'll talk about corporate and shareholder basis, which is a calculation. It's much more simple because shareholders are much simpler in a corporation. They buy stock. Now there can be more to it than that. There are rights of shareholders and things like that. But that stock that they hold is an investment asset. As shareholders, they're separate from the owners. And so it's basically much simpler than partnerships, right? Where there's so much that could be going on. People are putting in property, but it is that similar concept of basis, right? Okay, which is something that you have in an asset. So determine corporate taxable income and tax liability. So remember, corporations pay taxes, and this is part of the reason why the corporate structure, and it's just the nature of small business, corporate structure doesn't make as much sense. Now, even though they pay taxes in practice, because corporations get such large kickbacks and such like that, they don't actually pay the taxes, right? Like it's very uncommon for them to actually pay the taxes. Now, Schedule L, M1, and M3 are only required for businesses of certain sizes, similar to the partnership. And remember, Schedule L is like the balance sheet. And then Schedule M and M3, they reconcile the tax changes from the accounting changes because this balance sheet is based on the accounting. And so the M1 and M3 show how the changes, how you get from taxable income under the accounting to taxable income for taxes. So it's running what are called M1 adjustments. Those are your adjustments from book to tax, book accounting to taxes, book to taxes. how you say it in the industry. So they're book to tax adjustments, and you're running them through the balance sheet accounts, because all of those adjustments are based on income and expense items, which are temporary accounts. So this is a check to make sure the business is right and to make sure that their records are right and they're not hiding money. And that's why it's not required of super small businesses. And it also brings the owner's equity into that equation as well. That's the difference between M1 and M3. Then we'll talk about some other corporate issues. Like I said, things get rather complicated. We're not going to go that deep. And then they throw in SCorp here at the end. And we'll see how much we end up covering of that. So, corporate formation and filing requirements. So, the corporation is the oldest type of business. Just like any business, they sign up with the state, right? And they file an annual report, just like with an LLC. And of course, with that report, they pay a fee. Now, you really, with a corporation, need to use a lawyer. And this is something that I stress. And we'll also see that corporations are called C-Corps. That's kind of a nickname, C-Corp for them. And they must use articles of incorporation, bylaws. All of this is very similar to the LLC. This is just talking about that legal aspect. So corporations, large corporations, must use accrual. And then corporations with average annual gross receipts of $5 million or less can use cash basis. Some of these rules recently got far less restrictive for using accrual. And I think that that's really unfortunate, because if businesses aren't using accrual, then they don't really know their profit margins. So that requirement has enabled accountants to help business owners for many years actually do things right. So it's gotten a bit more lenient. If they have inventory for sale to customers, then they must use accrual as well. But there are exceptions to this too for calculating cost of goods sold and such. Because remember, when you buy inventory, it becomes an asset on your balance sheet. And then when you sell that inventory, it is sold as cost of goods sold. But under cash basis, when you buy that inventory, it would just be expensed immediately. So there are exceptions to this requirement for businesses that are doing 1 million in annual gross receipts or 5 million as well. So otherwise, they get to choose how they file their first return. And then if they want to change it later on, they must actually ask permission. There's a special form that they use to request permission to change their accounting method between cash, accrual, and then there are some other combinations. Like you can use accrual for the activity of the business, income, direct income, cost of goods sold, like such as related to inventory. And then for like bills and other general operating expenses, use cash basis. And that is a very common combination of accrual and cash method. So C-Corps can choose an accounting period when they file their first return without approval of the IRS. They do that just by filing. But most people use a fiscal year end. Remember, fiscal year just means the standard year that most individuals use as well. January 1 through 12/31. That is a fiscal year. But they say fiscal year for many retailers ends on January 31st, because if they did it on December 31st, that's their busy season. So they can use this fiscal year and choose a different date based on when they're most active, so that their entire busy season is reflected under 1 year, so that they can compare from 1 year to the next without half a busy season being under one fiscal year and half a busy season being under another. All right. So a corporation can use either cash or accrual method of accounting. True. Corporate tax returns are due if no extension is required. So that's right here. So beginning in 2016, the due date for corporate returns depends on the fiscal year of the corporation. For corporations operating a year that ends on June 30th, the return is due on September 30th. So that's July, August, September 15th. So it's the 15th day in the third month after the year end. And so that for a standard year end, right, that ends on 12/31 would be January, February, March 15th. And that has notoriously been the partnership due date as well. But you can file a 7-month extension from that date for a maximum period of 10.5 months. For all other corporations, so if they don't have a fiscal year, if they just have the standard annual year, then the initial filing date is the 15th day of the 4th month following the year end, which puts us at April 15th. So the standard calendar year taxpayer is April 15th. All others, if they have another type of fiscal year, then they're 2 months, and then the third 2 months, 15 days after the due date. Otherwise, it's due April 15th, and then they can file a 6-month standard extension for a total of 10.5 months. That's adding in that 4 months, 15 days as well. So corporate tax returns are due when, if no extension is requested? April 15th. When were partnership returns due? They were due March 15th. Now, the tax year of a corporation must end on December 31. True or false? That is false, right? We know that. Okay. So this concept of basis, they refer us back to partnership return, right? There's the basis of the ownership interest. So the stock in the case of the corporations in the hands of the owner. So the basis of the ownership interest in the hands of the owner. And then the basis to the corporation of the property exchanged for the ownership interest. So for a corporation, that is usually cash, right? When a corporation is formed, individuals purchase or otherwise acquire stock in the entity. It is most often, cash. And that's what our stock markets are based on. However, that doesn't mean that there can't be other property used. So stock acquisition is, in effect, an exchange of cash or property for stock. And it can be a taxable transaction especially if there's property involved, right? If the transfers, so that's the shareholders, who actually formed the corporation, control 80% or more of the corporation immediately after the exchange is generally tax-free. That's considered so there's 2 main types of corporations. There's private and there's public corporations. So this is certainly a private corporation, but even if the owners owned less than 80%, even if they own 50%, right? As long as it's not being offered to the general public to buy stock, then it's considered a private corporation. If it's being listed on a stock market for anyone to buy and for investors to include in portfolios, then it is a public corporation. So this is the corporate return, which is what I really wanted to dive into. Much like the partnership return, you'll see income here at the top, all different types of income that a business can have. And then we see all types of expenses that a business can have. And you may recognize these categories. They are quite standard. Taxable income down here, and then we just get right to it. It's all basically on this front page. Signatures from the representative of the business, paid preparer signature. Then we get into dividends and deductions. So this is where we look at dividends received by the company, because oftentimes there are a pyramid of businesses used for corporate and partnership structures. This can get really confusing, but that's what they're asking about here. Like, Are they moving money from public utilities up? Are they moving money from different businesses up? Because that is a common thing that happens, and they must be consolidated according to certain rules based on the percentages that they own in the businesses below. And so that's what this Schedule C, the page 2 of the corporation, is all about. Because people who own stock in a business, it may just be another corporation that owns all that stock. Those types of setups are common. That's how I started doing taxes in those types of partnership pyramids, they're called. And that was my first exposure to filing taxes. So Schedule J, now we're on page 3. This is really the detailed of the tax computation and payments. This is where you see all of these tax credits. And here we have all of these refundable credits. They have more refundable credits than we do as individuals. And it's so detailed. The rules are quite extensive here. So Schedule K, of course, we had a Schedule K for partnerships. This is a bit different. This is giving us the information about the corporation, the type of accounting method they use, their business activity code, business activity, product or service, EIN. So this is all informational about the company. And this is, again, following up some more information on the owners, the direct owners of the company and how much they own of the business, and listing their names and what they own. If not, are the corporation's total receipts, oh, I can't select here. What happened? Oh, I opened it. Number 13 here, are the corporation's total receipts, page 1, line 1A, plus lines 4 through 10 for the tax year, and its total assets at the end of the year less than $250,000? If yes, the corporation is not required to complete Schedules L, M1, and M2. Instead, enter the total amount of cash dividends and the book value of property distributions other than cash made during the tax year. So if the total assets, total income, and its total assets. So like a service-based business may not have any assets, right? But a business with a building and stuff like that, it's going to be easy for them to exceed this requirement, and then they need to fill out Schedule L's, M1 and M2. But if it's a service-based business, then it may be easy for them to be below this amount if their income isn't above this amount. Okay. We'll keep going here. Now this is page 5 and similar to the partnership. You should recognize this. This is Schedule L, and you can see here it says balance sheet per books. So this is the accounting balance sheet. Assets equals liabilities plus owner's equity down here at the bottom. And then here Schedule M1, net income per books. So that amount, I did that again. That amount, net income per books on Schedule M1, that is showing up under here in retained earnings, okay, for the balance sheet. So we're going to start with that, and then we put our federal income tax per books, and then we are going to reconcile the difference for all the adjustments we had to make, and we're going to match page 1, line 28, okay, which is this amount minus line 9. So this is our income with deductions. This is our expenses with deductions. We take this amount, line 9, minus this amount, and that's the amount that should match page 1. So this is a really good reconciliation to make sure that the accounting here matches what's being reported on the return. This is a really complicated form to fill out, so don't feel like you need to know this. The software, as you saw with the partnership, really takes care of this. You just enter the different amounts, and as long as there's nothing tricky going on and there's no overrides, most of this flows through. It's just if the numbers aren't right that there's a real problem, or when things just get really complicated for a lot of businesses, which we won't be touching here. So, and then Schedule N2, this is just looking at retained earnings at the beginning of the year, and then what our net income was, and then checking that to make sure that retained earnings is actually reconciling correctly as well. All right, so let's look at a little example. Gina transfers an apartment building to GGG company in exchange for all of the company, for all the stock in the company. The building has a basis of $100,000 and a fair market value of $500,000. And debt assumed by the company is $300,000. Even though Gina controls more than 80% of the company immediately after the exchange, the transaction is taxable because she has debt relief in excess of basis. She has a gain of $200,000 because her debt was relieved of $300,000 minus her building's basis of $100,000. So remember, we would start with the fact that what is her adjusted basis? $100,000, the same adjusted basis of the building, and then debt relief of $300,000 since it's just her and the corporation minus $300,000, so she would have a taxable gain of $200,000. Now, this example is a lot like the partnership calculation, right? As opposed to a big stock, a big 1120 shareholder stock type of business. Now, the reason they're doing this is because, like I said, the book is really taking this approach from an individual perspective of these businesses. So, and you can read these rules right here above the example. This is covering the exception to the 80% rule, which is really more of this individual owning a corporation type of situation. So the second case involves an individual who contributes cash or property and receives in return stock plus other cash or property. This extra cash or property is called boot, as we well know. In this case, the taxable gain is the lower of the fair market value of the property received or the realized gain, which is the fair market value contributed less the tax basis in the property contributed. So as you're doing these, be sure to write down the numbers, right? Because it's really hard to just talk about them. Like, you want to write them down. And that could be helpful to do even as I'm going over them directly here in the software. So, and this is a great review of what we covered for partnerships and for property, right? So Ernie receives the stock of EBU company in exchange for contributing a machine with a basis of $15,000 and a fair market value of $25,000. Ernie also receives $3,000 cash from the company. The gain on the transfer. So what happens, right? He contributed a machine with a basis of $15,000 and a fair market value of $25,000, which means he got $25,000 worth of value, right, when his basis was $15,000, and he also received $3,000 cash from the company. So the gain on the transfer is $10,000, the difference between the basis and the fair market value, and the gain Ernie must report is $3,000 because it's the lower of the gain or cash received, which is what it says up here. Second case involves an individual who contributes cash or property and receives in return stock plus boot, that cash. So the taxable gain is the lower of fair market value of the property received or realized gain. So this was the realized gain, but it's the lower of the realized gain, fair market value of property received, or realized gain, and the fair market value of property contributed less the tax basis of the property contributed. So there we go. So let's continue down here. So the corporate entity, the basis to the corporate entity. Remember, there's the owner side and then the corporate or the business's basis. So to the corporate entity, the basis of the cash or property received is equal to the basis in the hands of the shareholder plus any gain recognized by the shareholder. So the basis of the stock in the hands of the shareholder is equal to the basis of the property contributed plus any gain recognized minus boot received. Boot includes relief of liability, just like before. This is just like the partnerships. You could look at your partnership cheat sheet. The amounts of inside and outside basis for stockholders in each of the three previous examples are as follows. So here they're showing us stock basis to the shareholder. So this is the outside basis. And then the property basis to the corporation, the inside basis. Remember, this is just like our partnerships. Now, often this is not common for businesses to be like this small anymore for corporations because they have the LLC, which makes things much easier. So I normally don't recommend the corporation. People think, oh, it's better because it protects my liability more, but it actually doesn't if you're a very small business, because the whole point of the corporation is to have the investors separate from the managers. And when that's not the case, so that's like how Steve Jobs lost his job at Apple, because management is separate from the owners. In these types of small business situations, the shareholder is the same person as the owner, which just isn't really the point. I mean, it happens certainly, and it's common, and a lot of people choose it, right, who have small businesses, but it's just kind of counterintuitive in a way. So anyways, shareholders do not recognize losses as a result of the formation of the corporation when the 80% test is met, which means that the shareholders own at least 80%. The people who formed the corporation are the shareholders, and they own at least 80% of the shares. If an individual provides services in exchange for stock upon the formation of the corporation, the individual will recognize ordinary income equal to the fair market value of the services. That's always the same, right? Unless a C corporation stockholder increases or decreases his or her proportionate ownership, which means he buys or sells more stock, there's generally no adjustment to the outside basis over time. And so that's different from the partnership because of this separation of ownership from the company and management. Instead, on the inside basis, the shareholders who own the business, if they're working in the business, they get a W-2. They're treated as an employee. So it's very different. So when forming a corporation, if the transferors, which are the owners, control at least 80% of the corporate entity, which is through stock, then the formation is generally tax-free. True or false? Let's go back and look. What did we say here? If the 80% rule is met, a stockholder could be required to recognize gain in two cases, right? There were two situations where they could recognize gain. So is it generally tax-free? Yes, it is generally tax-free, right? Is that how the taxation is generally tax-free. But we have these two situations where they could be required to record gain if they actually receive boot, and if they exceed their basis in the business, because that must be taxed. A basis can never go below zero in a business because it's an asset, and an asset has to have a value. So in the case where it goes below that 200,000 example, then you're taxed on that 200,000, and that 200,000 becomes the basis in the business. Okay. The basis to the corporation of property received is equal to the basis to the corporation of property received is equal to, remember, this is the same as with our property rules and with our partnership rules. So the basis is going to be what? The fair market value, right? The business has the fair market value, which should show us that here. Yes. So the property that Gina owned was the fair market value was $300,000, and that's why that's the value to the business, $300,000. So they use the fair market value for the inside basis, the company's basis. Arturo contributed land with $100,000 and a basis of $40,000 to a newly formed corporation in exchange for 90% of the stock. So his basis in the stock is his adjusted basis, right? What is his adjusted basis? $40,000. Now the inside basis of the company would be the $100,000. Okay. So taxable income and tax liability. This is an outline of how we get to tax due. In the corporation, there is no adjusted gross income. So they kind of, again, approach this comparing it to the individual. Instead, we have total sales minus cost of goods sold, which we have with products. That equals our gross profit. Then we add in all other types of income and then minus out all other types of expenses. And that gets us to taxable income before special deductions. And this is where corporations then have all of these special deductions, net operating loss deductions, dividends received deductions. And what that's doing, basically they take deductions for their investments in other businesses, and that equals taxable income. Then we get to their tax liability times their tax rates, and then, which were just very much cut, and that equals, just like us, the payments during the year minus the tax liability. Is there an amount due or is a refund due? Capital gains and losses. So just like we learned before with individuals, which is what they talk about here, we can deduct a net capital loss of up to $3,000 with any excess being carried indefinitely. SCorps are not permitted to report any net capital losses, and instead capital losses can only offset gains. In other words, the amount on line 8 must either be positive or zero. It can't be negative. And so that really encourages reinvestment for corporations. It doesn't tend to be a problem. They're going to use those losses to invest in new things. And that's why the rule is that way, because it encourages them to continue investment even when they have losses. So corporations are permitted to carry back excess capital losses 3 years and then carry it forward 5 years. So they start and they must carry it back and then carry it forward. They have to go in order. But it's only against capital gains, which means sales of assets. So if they had income from capital gain in a prior year, they would need to go back to the 3rd year prior, look at it. Do they have capital gains? If yes, they would need to amend and get that money back. If no, then they would go to the 2nd past year. Okay, are there capital gains? No. Go to the last year. Capital gains? Yes. Amend. No. Don't amend. And then continue carrying it forward. And this is just an example of how to carry that back, as I just explained. Charitable contributions. So charitable contributions are permitted, but the deduction is limited to 10% of taxable income. Unlike with individuals, if you remember, it was 50%, and now they raised that to 60% of taxable income. So Szabo company reported $50,000 of taxable income before charitable contributions. The company had charitable contributions of $8,000. So Szabo's charitable contributions are limited to $50,000 times 10%, taxable income times 10%, and therefore Szabo's taxable income will be $50,000 minus their charitable contribution of $5,000 for $45,000. And it can carry forward the $3,000 that it didn't use, $8,000 minus $5,000. And then they talk about property instead of cash. Now we have the dividends received deduction. So this is based on companies that own companies. So if the company owns less than 20% in another company, they get a dividends received deduction for 70% of the dividends received. If they own 20 to 80% in a company, then they take an 80% deduction for the amount of dividends they receive. So they're paying taxes on 20% of the dividends they receive from another company. They're paying taxes on 70% of the dividends they receive from a company if they own less than 20%. And if they own more than 80% or more, they pay nothing. So they could own 80% of a company, but they'll pay, they get the deduction for 100% of the dividends they receive. So they pay zero taxes on the dividends that they earned off their investment in another company. And this is a big way that companies don't pay, as much tax. It's initialed the DRD. It can be limited if taxable income before the DRD or any capital loss carryback, the one we just talked about, is between 100% of the dividend and 70% or 80% as appropriate of the dividend. The DRD is limited to taxable income multiplied by the appropriate percentage here. So that is a limitation. So Silva, here down at 15.7, we'll look at this. Silva Silverware owns 30% of Fredona Flatware. Fredona paid $20,000 dividend to Silva. Silva's taxable income before the DRD was $50,000. So remember, we got to look. They own 30%, so that's this middle area, 20 to 80%. So they're going to get a dividend deduction of 80% of the dividend they received. But there's also a limitation based on the business's taxable income times 80%. So Silva's taxable income before the DRD was $50,000. So $50,000 is more than the $20,000 dividend. So we'll take the $20,000 dividend times 80%, right? Now, if the dividend was less than, if the taxable income before the dividend was less than $20,000, that is when that limitation would end up applying. So that's going to be what this example is. They say use the same information before, but except that Silva's taxable income before the DRD was $5,000. So Silva's taxable income is not between 80% of the dividend, $60,000, and 100% of the dividend. Thus, the DRD is not limited. So it's more in their favor in this case. The DRD can be limited if taxable income before the DRD and any capital loss is between 100% of the dividend and 70% of the dividend, or 80% if they're in the middle bracket like we were. But since it was not between that, since we had even less income than that, it's not even limited, which is, no, I thought that example covered what I was explaining. So this one does. So this is the third situation. So this time, Silva's taxable income before the DRD was $18,000. So in this case, Silva's taxable income is in the limitation area between $16,000 and $20,000. And therefore, Silva's DRD is limited to 80% of taxable income before the DRD, which is 18,000 times 80%. And in that case, it applies. So those are some good, simple examples that explain this. Now, this concept here is looking at the difference between organizational expenses and startup expenses. And this is something that I believe we should have touched on in the self-employed section, although it is kind of more of an overview. There is a difference between what essentially are called startup costs and organizational expenses. Organizational expenses and startup costs have the same rules. However, organizational expenses are related to forming a corporate business. They're basically legal expenses and the fees you pay to the state, versus startup costs are the costs, just ordinary operating costs that you spend to start the business. In both cases, you can't deduct these until you actually start the business. So every business must know the day that it opens its doors for business, quote unquote. And that would be applicable for a local in-person store, right? That literally opens its doors. It doesn't have to have any sales, but has the business actually started what it is in the business that it intends to do. Once it starts, you can begin deducting expenses, and you can deduct up to $5,000 for organizational costs and $5,000 for startup expenses in the first month. Other than that, the remaining costs for each category are deducted over 180 months, right? Because that's contributing to the start of the business. So that's a way to allocate the expense in relation to the income being earned. If the total organization expenses that you spend are more than $50,000, then there is a limitation that's explained there. Corporate tax rates. So these are the corporate tax rates, which these were just changed, but this is what they were before. So now I believe that they are not over 10%. Was the most recent change, but you can see this is the same way that we looked at individual rates. Taxable income over zero, but not over 50,000. So $0 to $49,999 is 15%. 50,000 to 75,000 is at 25%. So remember, the first 50,000 is still taxed at 15%, which is this 7,500. And then you add to that 25% of the amount over 50,000 up to $74,999. And then for 75 to 100, it goes to 34. So you can see these rates, right? These were very kind of similar to individuals. But we actually had a higher bracket for over 15 million, which I think is good. I think they should break out these rates for the high income earners as well. Like someone making a corporation making 335,000 should not be paying the same taxes when making 10 million. Like that's crazy. I think we can all agree there's a big difference between 330,000 and 9.5 million. So anyways, which is kind of what it's talking about there. So estimated tax payments, corporations must pay estimated tax just like individuals. Their estimated tax dates are April 15th, June 15th, September 15th, and December 15th. They report them on Form 1120 at the end of the year as well. Large corporations have special safe harbor rules for quarterly taxes. They must make quarterly tax payments essentially. Now, a net operating loss, if the business's expenses exceed its income, it can carry the loss back 2 years and then carry it forward 20 years to offset income. Alternatively, the corporation can affirmatively elect to waive the carryback period and only carry the losses forward. And it is irrevocable. You can't change your mind. And this is the same thing that individuals. Those were the same rules for individuals. However, the most recent tax changes I know took away the carryback rule for individuals. I'm curious if they took back the carryback rule for corporations as well. So corporations follow the same tax rules for capital gains as do individuals. False. They do not get to deduct up to $3,000 per year, right? The tax liability of a corporation with taxable income of $520,000 is, you can calculate that using this, just like we did before, right? You'll go all the way up to this bracket here and calculate the amount over $113,900 at 34% and add the two numbers together to get your total taxes. And that's all I'm going to cover. They're recapping the charitable contribution and the organizational expense, which is great. I'm going to finish up this video before it gets too long. Transactions with shareholders, so dividends and distributions. For a company to pay a shareholder dividends, they must have earnings and profits, which means they must have net income. And then those are called distributions, just like with our other types of businesses. It's fairly straightforward. These are some great examples. When a corporation closes, it's called a corporate liquidation, and shareholders can report a capital gain or loss equal to the difference between the basis that they have in the stock, that outside basis, in the fair market value of anything they receive, such as cash or other property in these small business situations. This section takes a closer look at this Schedule M1, which I already explained, really going from net income to net loss. This talks about these pyramid companies that I was mentioning, which are called parent subsidy groups. So this is what happens for that DRD deduction, because the company owns stock in another. And if they own at least 80% of one or more other corporations, then they're called a parent group. Parent and subsidiary group, with the corporation that owns the stock being called the parent and the ones below being called subsidiaries. And they can end up filing a consolidated tax return. They can be required to do that, combining all of their income, because they are technically a consolidated business because they just own everything, right? And then a brother-sister group is a little bit different, and it exists if 5 or fewer persons own 2 or more corporations. And so there are 2 tests to see if they meet these tests, then they also must file based on a common percentage of the corporations. This is an example that covers that. Now, there is an alternative minimum tax based on 20% of alternative minimum tax base. And this is similar to individuals that also have AMT as well, to prevent people from not paying taxes. However, for corporations, this just based on what the AMT tax base is, it's not very effective at preventing businesses from paying taxes. So with the SCorp, we'll see the first page is pretty much the same. However, the main difference here in the return is that we have Schedule K, just like with a partnership return, and it looks a lot like a partnership return. And then there is a Schedule K1 for each partner. Now, any owners that work in the business, they must be paid through a W-2. Now, so this subchapter S, election, these are the requirements for someone to be an S-Corp. They essentially must be a smaller business, a domestic company, 100 or fewer shareholders, 1 class of stock, and they must have shareholders who are U.S. citizens or resident aliens. They can't have a foreign shareholder as part of their business. And they use Form 2553 to make this election. Remember, this is not a legal type of business. It's just an election. Now, there are 2 different readings for this week in Connect, but they were pretty small, even though they're on these sections. So be sure to read through here. And you can check out these examples, because essentially we're going to combine what you just learned about a corporation with the S-Corp. I don't know why they didn't show the Schedule K ones, because that's like the biggest part. We have these Schedule K items flowing through onto the Schedule K ones, but this is really an overview of that S election. All right. That is all. I'll be doing some more videos of the problems we go through as well. This summary page, by the way, is a great place to kind of like get an overview of the details for cheat sheet as well. Okay, I will see you guys in the next video when we're doing more problems next week.